I am Elizabeth Viverito, Membership Manager here at the SBBN, and I welcome you all. If you are able to see our screen and hear our audio, that is wonderful news. If you're having trouble, please do message us via the questions area or the chat box. My colleague David is standing live to help facilitate any questions. You are able to contact my colleague David Sheffick at Skype or, as I mentioned, in the chat or text box. David, are you there?
Yes, I'm here.
Great. And can we go to the next slide so they can see your Skype name?
That's Almin.
Oh, sorry, Almin. And so if you have any technical problems, as I mentioned, go ahead and enter those into the chat box. You can Skype David Sheffick. His name is right there. After the webinar, this will also be made available as a video on our web community, as are all of our webinars. So you can log on and go to our network to the video area and view any of the archives from our past webinars. And on the next slide, we have a few upcoming webinars coming up. This is part of our webinar series. Almin, can you go to the next slide? Thanks. On April, we have a webinar as a follow-up to the recent workshop that we just did in Tanzania. The webinar is called Advancing Women Entrepreneurs, Financing Women-Led Businesses. We're going to have a few of our speakers who presented at that workshop come join us. We'll have a follow-on credit scoring webinar on June 19th that goes a little bit more in depth into designing and implementing a successful system. And then later this year, we'll have a few more. All of our webinars are free of cost to SBBN institutional members. So if your institution is a member, any individual at your organization can join us. I know we have at least one or two groups today who are joining as a group in a conference center. So thank you so much for doing that. We highly encourage you to gather your colleagues and join us as a group and then have a short discussion afterwards about the content we presented. So I will go ahead and introduce our facilitator for today. We are very, very lucky to have with us Elmine Vandermeer, Elmine Esbach from South Africa. Elmine has more than 20 years of experience in the areas of risk management, audit, compliance, and interbank negotiations and payments. She's currently a director at an accounting and consulting firm. Prior to that, she was with Tiba Bank in South Africa. And Elmine was appointed director of the board of a company representing the smaller South African banks in the payment industry. She was an alternate director on the board of the National Payment Switch of South Africa. And I know that in several of the projects that she's done, she specializes in developing and modeling risk management solutions and strategies for corporate clients, forensic auditing, and compliance consulting. Elmine developed a enterprise-wide risk management model aimed at small and medium enterprises, which has been successfully implemented in several countries throughout the world, and she's also lectured on the topic throughout Africa. So I will go ahead and hand off to Elmine right now. Welcome. Thank you so much for joining us. And I know you wanted to share a little bit more about what you've done in the credit scoring area specifically. So thank you so much, Elmine.
Thank you, Elizabeth, and thank you everyone for joining us for this credit scoring webinar. As Elizabeth mentioned, this will only be an introductory webinar, but I'm sure that even if you have been through the whole credit scoring exercise, that you might find one or two things very interesting in this. As Elizabeth mentioned, maybe just highlighting a couple of the exciting projects that I've done in credit scoring. I worked in China doing a credit card facility, credit scoring for a credit card facility, which was extremely exciting, and then also a behavioral scorecard for a microfinance institution in China. I worked with a bank in Mozambique, where they had little or no data and almost no reliable credit bureau available. And I think this might be one of the issues that you might be struggling with currently. I've done a couple of credit scoring exercises throughout Africa and as well in South Africa. Having said that, let's continue with the webinar. What is credit scoring? Credit scoring is an objective risk management tool used to rate customers based on the probability of a business event or customer action, resulting in profitable decision making. Talking about business event or customer action, we look at things such as timely credit returns, risk of default, retention or cross-sale. Profitable decisions such as accept or reject credit application, increase or decrease a credit limit, send, hold, a cross-sale offer, etc. Scoring is the most widely used in lending for all stages of a credit life cycle, from borrower acquisition to customer management to debt collection and recovery. So why do we do credit scoring? I think one of the biggest benefits in my mind is the uniformity and objectivity it lends to the decision-making process. Scoring technologies can be used as an objective risk management tool which help ensure centralized, uniform, more consistent and reliable decision management across your organization. Quality and profitability of scoring-based operational decisions can be statistically monitored and gradually improved or adjusted to new market conditions. Increased profitability of everyday operational decisions, such as customer acquisition or customer relationship management decisions, decrease decision time, streamline credit operations, ensure both automated and individual approach to every customer, also automate mass operational decisions and reduce labor costs, in the end reducing your bottom line, ensure agility to changing market conditions, and reduce human decision error and obsolete subjectivity biases.
And Almeen, we had a quick question. What would you say is the biggest benefit to a financial institution on implementing credit scoring?
I think one of the biggest benefits is the uniformity and objectivity it leads to the decision-making process. There is also a cost benefit in terms of speed to market with new products and also competing on a day-to-day level with other competitors in the market. Having a quick turnaround on credit application certainly gives you an edge in the acquisition of new market share.
Great, thank you.
So what is a scorecard? To score customers, you need a scorecard. Scorecard is a mathematical model represented as a set of weights assigned to customers' characteristics that affect his creditworthiness or any other target behavior modeled by the scorecard. To create statistically based scorecard, you need to apply statistical or predictive analysis to your historical data. Historical data meaning data about your past and current customers. The most widely used statistical method for scorecard development is logistic regression. Logistic regression is a statistical analysis used for predicting the outcome of a dependent variable based on a set of predictive variables. Basically, it converts a dependent variable into a probability score. There are different types of credit scoring, and I've listed three. There are more, but we'll quickly run through them, and if you do have questions, we can maybe take them. Application scoring quantifies the risks associated with loan applications by evaluating the social, demographic, financial, and other data collected at the time of the application. It facilitates customer acquisition decisions. Used in application processing systems, application scoring helps to automate the whole process of loan origination. Behavioral scoring quantifies the customer behavior to improve your credit portfolio management and customer management. Behavioral scoring helps you to better understand your customers, And the better you understand your customers, the more effectively you can respond to their individual need and increase your bottom line. It facilitates customer management decisions. Used in credit management or portfolio processing systems, behavioral scoring helps to automatically segment and rate accounts, customers and portfolios, thus allowing you to efficiently manage a particular borrower's credit account as well as the entire credit portfolio. Moving on to collection scoring. Collection scoring quantifies the probability of recovery of the outstanding balance for those accounts in arrears or collections. A collection scorecard statistically estimates debtor willingness to pay and ability to pay, and thus helps to define what action should be done to increase collections. It facilitates debt management. Used in debt collection systems, collection scoring helps you to improve your collection and recovery efficiency, reduce write-offs, and decrease staff costs. Another two types of credit scoring are fraud scoring and psychological scoring. Fraud scoring rank order applicants according to the probability that an application may be fraudulent, or thus alert you of potentially fraudulent applications before you book an account. It facilitates fraud detection and prevention, helping you to instantly decide which of the applications should be rejected or set aside for more in-depth evaluation due to high fraud probability. Used as addition to loan origination systems, fraud scoring helps lenders to increase their profits and enhance their customer service by identifying potential fraud at the earliest possible point. Fraud scoring is a complicated system, and in my opinion it's better to get a company that specializes in this rather than doing it yourself. Psychological scoring is quite a revolutionary idea whereby customers are profiled based on computer-based credit screening. For each of these types of credit scoring, a scoring method or scorecard can be used such as expert scoring, statistical scoring, or a hybrid of the two. The scoring methods will be covered in the later slides. Expert versus statistical scoring. If you have no historical data, you can create an expert or just mental scorecard by selecting customers' characteristics and corresponding weights based on expert opinion. After a period when you will have historical data about delinquencies, you can gradually switch from an expert to a statistical scorecard. One of the major obstacles in developing a scorecard is that the credit bureaus are either weaker or do not yet exist in some rapidly developing markets. Developing market banks or microfinance institutions cannot use credit bureau information. Instead, they must develop scorecards using their market knowledge, experience, and internal data. Psychological scoring claims that EFL test provides the same credit scoring predictive power found in more sophisticated systems such as using credit bureaus. Considerations in SME lending. Small business lending decisions are tougher than consumer and mortgage loan decisions. Loan officers consider a wider range of factors such as financial capacity to repay the loan, willingness to repay the loan, collateral pledged, and the specific terms and conditions of the loan contract. Market and industry-specific risk factors make it difficult to adapt scorecards across markets and industries. At the same time, bankers do not want analysts to spend hours spreading a small company's financial statements and analysis to underwrite a $20,000 loan. The most appropriate way to underwrite a large book of SME loans is with a simple scorecard that evaluates the mix of financial and non-financial factors and is customized to specific local conditions of the country and the lender. Defining the scorecard. To make automatic decisions, you need to define score cutoff or threshold that will divide good customers that display positive behavior, such as good profit and timely repayments, from bad customers that most probably will display negative behavior, such as default. Those customers whose score is less than the cutoff point are rejected. The automatic decision for them will be no. Those customers whose score is higher than the cutoff point are accepted. The automatic decision for them will be yes. Based on consumer score or customer score, you also can segment your customers into risk groups. A risk group is defined by the odds of being good relatively to the odds of being bad or delinquent. For example, a borrower that belongs to a group with odds 300 to 1 has very low risk of being delinquent. But if a borrower belongs to a group with odds 5 to 1, he or she has unacceptable credit risk. Cut-off point approach assumes that in any case you will have a small amount of bad customers in the accepted segment. For example, in the 300 to 1 risk group, you will have 1 bad customer for every 300 good customers. Similarly, you will reject a certain amount of good customers while rejecting all applicants below cut-off point. The steps to develop a scorecard. Step 1 is to determine the scoring strategy. Define how and for what purpose the scorecard will be used. The next step is to review available portfolio data, understand the quality and the quantity of information available about past borrowers. Step 3 is select the appropriate type of scorecard. There are 3 main types of credit scorecards that can be developed using internal data: expert, statistical, and hybrid. Build the scorecard. The steps in building the scorecard will be discussed in subsequent slides. After that, the scorecard must be piloted and then deployed. Building a scorecard. Expert scorecards. Quantify the institution's credit policy, market knowledge, risk preferences, and segment strategy. A very simple expert scorecard might be a checklist of minimum criteria the potential borrower must meet, whilst a more sophisticated scorecard would combine and weigh all key underwriting criteria, such that scorecard decisions generally agree with those made by credit officers. Because judgmental scorecards rely more on human expertise and organizational knowledge than on statistical relationships, building them might take more time and input from senior management. Statistical scorecard requires extensive data on past borrowers in the same segment that will be scored. Hybrid scorecard. A hybrid scorecard is a statistical scorecard modified to include variables that were either not available or not collected historically. New variables must be added and weighted in the same way as with judgmental scorecards, making the resulting scorecard a combination of the other 2 techniques. Steps to develop a scorecard. To develop a scorecard, we use historical data from the credit portfolio that have been freed from invalid records. Each record in the portfolio must have 1 or 2 possible values that characterize the borrower's credit behavior either as good or bad. After historical data have been prepared, the following actions must be performed to develop a scorecard: sampling preparation to train the scorecard, preparation and selection of borrower characteristics that are used to develop the scorecard, development of the scorecard, assessment of the quality of the scorecard, implementation of the scorecard and its subsequent monitoring. Since the result of scorecard development must be at best of all possible options, the above-mentioned sequence of actions is typically repeated cyclically. The following methods can be deployed to improve the quality of the scorecard: changes in training and validation datasets, changes in defined transformations of borrower characteristics, changes in scorecard development methods. After implementation, the developed scorecard is used in real time to facilitate operational decision making. To support the quality of its performance, one needs to periodically, monthly, quarterly, or annually monitor the scorecard and to readjust or recalibrate the scorecard if necessary. Historical data preparation. So what do we need to start scoring? The most important component of a scorecard is of course the data used. I want us to spend a couple of minutes on this topic, as your scorecard can only be as good as the data it is based on. Typically, we use historical data from the credit portfolio to start building our credit scorecard. As we mentioned earlier, if you do not have credit portfolio data available, it is best to start off with a judgmental scorecard by selecting customers' characteristics and corresponding weights. Once you have built up enough data over a period of time, you can move to the statistical scorecard as we are discussing now. In any database, there are likely to be some inconsistencies and incomplete data fields. It is important to clean the database of all of these incomplete records and using the consistent, complete data fields only to build the scorecard. Historical data should include a set of characteristics and a target variable. All of scorecard development methods quantify the relationship between the characteristics in the input columns and the good or bad performance in the target column. Many countries also face the challenge of reliable credit bureau data. The submission of credit records to these bureaus are voluntary and therefore not very reliable to use in scorecard compilations. The data that are reported is primarily negative and there are no set standards for definitions of data quality. In such instances where there is no bureau data available, institutions need to put other risk mitigating factors in place. For instance, in Kenya, the credit card issuers meet once a month to share negative data amongst each other. Those characteristics whose usage is not reasonable are excluded. For example, on the picture you can see that the good-bad distribution does not depend on the ownership structure of the SME characteristics. This is an extract from a scorecard that was done in South Africa in recent years. Up until about 2 years ago, the directors or owners of a privately owned company had limited liability. However, the Companies Act changed recently, and now the directors of these companies can be held fully liable for any debt made by the company. All borrowers should be marked in the target column as good or bad by a certain rule. For example, all the borrowers to pay in 30 days are good, but borrowers with a delay of more than 90 days are marked as bad. Data preparation and looking at exclusions. If you look at this data set, it is clear that any entry such as that for Bill Gates, would distort the scorecard. In any SME book, you will get the more profitable institutions. However, if you look at an analogy of Microsoft versus a moderately successful restaurant in a small town, it is clear that these types of records should be removed.
Hi, Almin. I have a question that came in from the audience. So, data cleanup and preparation seem like one area that an institution can underestimate the time and resources that are needed to complete. Who would you recommend is responsible for managing and performing the data cleanup?
Although it's logical to think that such a project be driven by the IT department, it has to be understood that this is ultimately a risk function. So, although the technology department drives this together with the inputs from credit risk is ultimately responsible for this exercise. Given the skill set of the team driving this project, there must definitely be statistical expertise, high IT expertise, obviously input from credit and your frontline operations, but in the end, risk is ultimately responsible for this. Training and validation data sets. How do we know whether the scorecard will perform identically when evaluating new borrowers and when using historical data? To provide an answer to this question, the credit portfolio data are divided into two parts, training and validation. The training dataset is used to train the scorecard, while the validation dataset is used exclusively for the purpose of validation. As a rule, 80% of available data is used to train the scorecard, while the remaining 20% is used for the purpose of validation. If there is a large amount of data, the validation dataset can compromise as much as 50%. If a certain category of borrowers is insufficiently represented in the credit portfolio, its distribution in the training and validation datasets must be specifically controlled, as this category must be proportionally represented in both datasets. Looking at binning, and what does binning mean? Binning means the process of transforming a numeric characteristic into a categorical one, as well as regrouping and consolidating categorical characteristics. So why is binning necessary? It increases the scorecard stability. Some characteristic values can rarely occur and will lead to instability if not grouped together. Binning improves quality. Grouping of similar attributes with similar predictive strengths will increase scorecard accuracy. It allows to understand logical trends of good and bad deviations in each characteristic. It prevents scorecard impairment, otherwise possible due to seldom reversal patterns and extreme values. It prevents overfitting or overtraining, possible with numerical variables. Scorecard implementation and deployment. One of the main conditions for successful use of the scorecard is the absence of significant changes in borrower characteristics over the course of time. In the development of the scorecard lasts for a long time, changes in the credit portfolio may occur. Since such changes are not reflected in the data that we use to develop the scorecard, then prior to the implementation of the scorecard into the process of evaluating borrower's creditworthiness, we need to recheck that the quality of the scorecard remains the same and to remove any deviations. Policy rules and definitions. To score is the natural criterion for formulating risk-based working rules for borrowers. Simpler rules can mandate the level of detail with which the institution analyzes the borrower's application depending on his or her score. More sophisticated rules can involve an individual selection of the interest rate or risk premium of the loan duration. In this example, the following credit risk and recommendations are made. For a very low risk with a very high risk, very low score with a very high risk, automatically reject the application. A low score with a high risk, strict application examination, application reject recommended. A medium score with a medium risk, detailed application examination. A high score with a low risk, automatically accept application. A very high score with a very low risk, automatically accept application and propose additional products. Lessons learned. In the first stage of implementing a new scorecard, we need to check that it is superior to the existing methods of risk evaluation or to the existing scorecard. For that purpose, we process the majority of incoming loan applications using our existing methods that are called Champion, while remaining loan applications are processed using the new scorecard that is called Challenger. Processed results are compared. If the new scorecard demonstrates a better assessment of borrowers, it will be used instead of old methods and becomes the Champion method. If needed, the new scorecard is improved while it is in the Challenger mode until we see an acceptable improvement in the risk assessment. To conclude, for banks in developing markets just starting down the scoring road, an expert scorecard running in the appropriate database software is only the beginning of a journey that will lead to ever more powerful risk models that open an array of possibilities for optimizing risk management and maximizing retail segment profits.
Thank you so much, Elmine. We do have one additional question that came in from an audience member. You have mentioned a lot of skill sets throughout the webinar. Who should be the champion of a credit scoring exercise at an institution, and who, in terms of positions and skill sets, needs to be on the implementing team?
The champion of the credit scoring exercise is ultimately risk. Obviously, there would be a functional inputs from credit and the frontline operations. The most important thing here is that business and risk must drive technology and not the other way around as often seen in these kind of projects.
Great. Thank you again, Almeen. We really appreciate you taking time to deliver this excellent webinar, and we're sure our audience has appreciated it too. I also want to thank those of you joining us in the audience today. We hope you found this to be an informative session, and we hope that you will join us again on June 19th when Almeen returns for the second part of this webinar series, which is titled Credit Scoring, Designing and Implementing a Successful System. Thank you again, and we look forward to interacting with you on the web community.